Amazon Web Services just posted the fastest revenue growth it has seen in 15 quarters, 28% year-over-year, $37.6 billion in a single quarter. The headline landed exactly the way bulls wanted it. Then the cash flow number arrived. Free cash flow on a trailing 12-month basis, $1.2 billion. 12 months ago, the same figure was $25.9 billion. That is not a rounding error. That is a $24.7 billion hole carved out of the same business while revenue was accelerating. The U.S. market spent most of Thursday threading between two simultaneous narratives. The first was the AI infrastructure boom in full sprint. CoreWeave reported $2.08 billion in first-quarter revenue, topping estimates, while revealing it had raised the floor on its 2026 capital expenditure to $31 billion, keeping the ceiling at $35 billion. The company now holds $99.4 billion in contracted revenue backlog, up from $66.8 billion at year-end. Alphabet continues to close the market cap gap with NVIDIA. As of Wednesday's close, Alphabet sat at $4.81 trillion versus NVIDIA's $5.05 trillion, a gap that has compressed sharply since Alphabet's blockbuster April 29 earnings report showed Google Cloud revenue growing 63%.
The mechanism worth examining is not the CapEx figure in isolation, it is the sequence. Amazon lands a partnership with Anthropic worth up to 5 gigawatts of Trainium capacity. Anthropic needs that compute. Amazon books the contract into its AWS backlog. Anthropic, having received investment capital partly from Amazon and from other hyperscalers, routes spending back to AWS to fulfill the compute commitment. AWS revenue rises, the backlog swells, the earnings per share beat consensus, and Amazon stock is described as having an AI-driven flywheel. The flywheel is real in mechanical terms. The question the cash flow number introduces is whether the rotation is externally powered or internally sustained. At $1.2 billion in trailing free cash flow, against a market cap that reflects a very different trajectory, the gap between the income statement and the cash statement is where the risk lives, not in the revenue line. This is where a countersignal emerges that complicates the warning. Amazon's own custom silicon is scaling at a trajectory that has nothing circular about it. Graviton, Trainium, and Nitro crossed a $20 billion annual revenue run rate in the first quarter, growing at triple-digit percentages. Amazon landed over 2.1 million AI chips in the trailing 12 months, more than half of them Trainium. Bedrock processed more tokens in Q1 than in all prior years combined, with customer spend rising 170% sequentially. These are organic enterprise workloads, companies that are not OpenAI, not Anthropic, choosing Amazon's proprietary infrastructure because it delivers better price performance than renting NVIDIA H100s. The reversal condition is precisely here. If Trainium adoption continues accelerating among third-party enterprise customers, the ones with no circular relationship to Amazon, then the CapEx being deployed now converts into durable, non-circular cash generation in 2027 and beyond. That is the Amazon early days argument. Sacrifice margin now, own the infrastructure at cost advantage later. The trap version of the same story is that enterprise Trainium adoption plateaus, the AI lab contracts remain the dominant backlog driver, and the circular dependency deepens as CapEx commitments extend further into the future. The two scenarios are not distinguishable from the Q1 revenue figure alone. They require watching what the free cash flow does as the Trainium ramp matures.
The historical parallel is explicit. Zacks Investment Research compared CoreWeave's current posture to Amazon's early e-commerce era, accepting deep losses in pursuit of infrastructure dominance. Amazon's investors who held through the 2001 and 2008 periods when free cash flow was negligible were eventually rewarded as the cost structure compounded in their favor. The analogy is structurally coherent. It is also the same argument that was applied to every capital-intensive infrastructure bet that eventually failed to achieve the scale required to make the math work. What distinguishes the two outcomes historically has been whether the infrastructure became the default substrate for the next generation of workloads or remained a specialized layer that incumbents eventually replicated at lower cost. AWS won the first cloud cycle because enterprises could not afford the upfront capital to match it. The question for this cycle is whether NVIDIA's H100 and H200 installed base, combined with the hyperscaler's own competing silicon, creates a ceiling on any single provider's compute advantage. For AMZN specifically, the near-term verification point is the second quarter free cash flow number, expected alongside Q2 results. Amazon guided Q2 operating income of $20 to $24 billion. If operating income comes in at the top of that range and CapEx growth begins to decelerate even modestly from the Q1 pace, the cash flow gap starts to close, and the circular backlog concern becomes a theoretical footnote to a real recovery story. If CapEx holds at the Q1 pace and operating income lands at the floor, the gap widens and the backlog composition becomes the next question analysts pursue. The Microsoft read is similar. Azure is doing the heavy lifting on revenue, with cloud backlog at $627.7 billion, but the same 49% OpenAI concentration applies. MSFT trades at a forward multiple that embeds substantial backlog conversion. The circular portion of that conversion is the variable the market has not yet fully priced. Alphabet enters this picture from a different angle. Google Cloud's $460 billion backlog carries the same Anthropic concentration, but Alphabet's custom TPU silicon and the 63% cloud growth rate suggest organic enterprise pull that is harder to dismiss. Alphabet's forward PE of 28 sits well below NVIDIA's 42, a valuation that reflects either more conservatism or more uncertainty about which part of the backlog is durable. The directional lean here tilts toward the AWS infrastructure win scenario, but only conditionally. The Trainium ramp is real and measurable. The circular backlog concern is also real and measurable. They are competing against each other on the same timeline. The free cash flow number in August is the benchmark, not the revenue figure, not the backlog total. If it recovers toward double-digit billions, the Amazon early days thesis gets its first confirmation. If it stays compressed near $1 billion while CapEx remains above $40 billion per quarter, the question about backlog quality moves from analyst note to market narrative. What would prove the infrastructure thesis wrong faster than anything else is an Anthropic or OpenAI decision to diversify compute away from Amazon. That has not happened. It remains the condition to watch. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.